Just now, oil broke $100 per barrel. For the first time since Russia invaded Ukraine in 2022, international benchmark Brent crude surged past $100 Sunday evening, climbing as high as $119.50 per barrel, the biggest single-day oil surge in decades, as the Iran war disrupted 20% of global oil supply for 9 consecutive days, more than double the previous record set during the Suez Crisis of 1956. J.P. Morgan, double the previous record in history, from a war that is now on day 9 with no ceasefire, with a new supreme leader installed under IRGC pressure, with Russia providing Iran military intelligence, with 150 tankers still anchored outside the Strait of Hormuz, and with the U.S. economy simultaneously bleeding, 92,000 jobs lost in a single February morning against a 59,000 gain consensus. Oil broke 100, 92,000 jobs vanished. And silver, sitting at $88 to $90 right now, is 48 hours away from the most binary macro catalyst of the year, tomorrow's CPI, the specific data point that will tell the Federal Reserve, Wall Street, and every precious metals investor on the planet whether the inflation that this oil shock is injecting into the U.S. economy is already showing up in the February consumer price data, or whether the worst of the inflationary shock is still ahead, still being priced into next month's numbers, while the Fed sits paralyzed at 98% hold probability. This is OG John AG, one handle, 2 platforms, the only fingerprint they cannot forge. This channel has never sold you a single thing and never will. Subscribe right now. Drop OG in the comments. Let's go. Oil prices kept climbing Monday, having surged past $100 per barrel Sunday, the first time it crossed that mark since Russia's 2022 invasion of Ukraine. Brent crude neared $120 a barrel in early trade before paring some of those gains to trade around $104, a 12% gain on the day. Triggered by the shock of the initial February 28 strikes on Iran, average U.S. gasoline prices reached $3.45 a gallon Sunday, up 16% from the week prior according to AAA. Ainvest, 16% in 1 week, at the pump, in America, where the CPI basket weight for energy is the specific component that will determine whether tomorrow's February inflation print comes in hot, confirming the stagflation trap, or somehow reflects the pre-war energy environment that the February data collection window partially captured. Here's the timing reality that most analysts are missing. The February CPI data was collected throughout February. The U.S.-Israel strikes on Iran began February 28th. The Hormuz closure became effective March 2nd. The oil spike from $67 to $119 happened between February 28th and March 9th. February CPI, which prints tomorrow, captures the energy price environment of February 1st through February 28th. The oil shock that pushed Brent to $119 is almost entirely a March phenomenon, which means tomorrow's CPI print could come in relatively moderate on energy, reflecting the pre-war price environment, while every person filling their gas tank this week is already experiencing the $3.45 post-war reality. And the March CPI, which will capture the full oil shock, does not print for another 30 days. WTI, the U.S. benchmark, sank 11.94% to $83.45 per barrel after President Trump told CBS News he thinks the war is very complete. Brent lost 11.28% to settle at $87.80. Prices fell more than 17% immediately after Energy Secretary Chris Wright wrongly claimed the U.S. Navy had escorted a tanker through the Strait of Hormuz, a claim the White House immediately corrected. Bing X, 17%, in minutes. On a false statement from the Energy Secretary that the White House corrected within the hour. That is the specific volatility architecture of this oil market right now, where a single social media post can move the global energy price by 17% because the market is so uncertain about the fundamental situation that any signal of resolution triggers a panic buying reversal. And when the false signal is corrected, when the Navy clarified it had escorted 0 tankers, the price did not fully recover. The truth landed. The market held the partial decline. Iraq's oil output has dropped by 70%. Goldman Sachs warned that if the Strait of Hormuz remains disrupted for more than 30 days, oil prices could enter a $140 to $150 range, potentially triggering a synchronized global economic downturn. The market has shifted from a projected 3.7 million barrel per day surplus to a significant deficit overnight. FX Empire, 30 days. Goldman Sachs' timeline for the $140 to $150 scenario. Today is day 10 of the effective closure, 20 days remaining on Goldman's trigger window, and the specific mechanism that would close the strait, restoring insurance market confidence, removing the physical security threat that Iranian drones represent, degrading Iran's capability to attack tankers, is a military achievement, not a diplomatic one. Military achievements are not announced on Truth Social before they happen. Now, the direct silver connection, because oil at $100 and 92,000 jobs lost, are not just macro headlines. They are the specific inputs that make silver near $100 before tomorrow's CPI, the most consequential technical and fundamental setup this market has produced all year. Stocks in Asia fell sharply on Monday as investors braced for the fallout from rising energy prices. Japan's Nikkei 225 closed more than 5% lower. South Korea's Kospi was down 6%. European stocks opened lower with the FTSE 100 and DAX down 2% and 3% respectively. S&P 500 futures fell 1.7%. Nasdaq futures dropped 1.9%. CME Group, every major equity market falling simultaneously, while silver approaches $90. That is the capital rotation signal that precious metals investors have been waiting for. The moment when broad equity weakness combined with currency debasement pressure and energy shock inflation creates the specific macro environment where institutional capital moves from risk assets into monetary hedges, not gradually, in sessions. Silver at $90 right now, with oil still above $87 after today's partial pullback, with 92,000 jobs confirmed lost, with the Federal Reserve paralyzed between fighting oil-driven inflation and preventing the recession that the jobs data is already documenting. With tomorrow's CPI either confirming moderate February inflation, which gives the Fed cover to eventually cut and takes real yields lower, bullish silver, or printing hot on energy, which confirms stagflation, destroys dollar safe haven credibility, and is the most directly bullish macro environment for physical precious metals in 46 years. Analysts warned Monday the price of oil could keep rising, with one warning of a game-changing and unprecedented energy crisis. Neil Atkinson, former head of oil at the International Energy Agency, said the effective closure of the Hormuz Strait is something energy markets had never seen before. Unless something changes very soon, we are in a potentially game-changing and unprecedented energy crisis, he told CNBC. Trading key. Game-changing. Unprecedented. From the former head of oil at the International Energy Agency, not from a silver bull account. From the institution that coordinates global strategic petroleum reserve policy for 30-plus member nations. An unprecedented energy crises, the 1973 Arab embargo, the 1979 Iranian Revolution, both produced the most extraordinary silver bull markets in recorded history simultaneously. Now the counter-argument, with full force. For now, markets appear to be betting the situation cannot last long and that navigation through the strait will ultimately be restored. I think there is a lot of optimism in the market. We saw that today with the collapse in oil prices on what we used to call verbal intervention from the president. The market is still struggling to process the scale of the disruption. Traders assumed for decades that no country would be allowed to shut the strait. The fact that it has happened at all is completely calamitous and unexpected. PR Newswire. Verbal intervention works. Trump's statement that the war is very complete moved Brent from $104 to $87 an hour. A $17 move on words. If a diplomatic breakthrough materializes before tomorrow's CPI, if Trump's unconditional surrender demand produces a surprise Iranian response, if China's mediation produces a Hormuz transit agreement for non-US aligned vessels, if the IEA emergency reserve release floods the physical oil market, the entire war premium in silver compresses as rapidly as it inflated on Monday's open. Saudi Aramco CEO Amin Nasser said there would be catastrophic consequences for the world's oil markets the longer the disruption goes on. While we have faced disruptions in the past, this one by far is the biggest crisis the region's oil and gas industry has faced. Global inventories of oil are at a 5-year low. BingX. The biggest crisis in regional history, from Saudi Aramco's own CEO. That statement, published today, is the most authoritative assessment of the severity of the structural damage that even a short-term Hormuz closure has already inflicted. 5-year low global inventories. Production shut-ins in Iraq, Kuwait, and potentially UAE and Saudi Arabia. Oil infrastructure at Shahran and Karaj damaged by strikes. These are not reversible in days. They are reversible in weeks to months at the earliest. And every week the shut-ins continue. Every week Gulf producers are forced to throttle production because storage is full and tankers cannot move. The damage to global supply compounds in ways that persist long after the strait physically reopens. Oil could rise to $150 a barrel by the end of March if travel through the strait does not start flowing again, said Homayoun Falakshari, lead crude research analyst at Kpler. Brent prices would rise above $110 if current conditions persist for 2 months. It was the first time oil prices shot above $100 per barrel since Russia invaded Ukraine in 2022. The G7 energy ministers will hold a virtual meeting Tuesday morning to discuss a possible joint release of oil reserves. Financial content: $150 by end of March. 20 more days. From Kpler's lead crude research analyst, not from a social media account. And the simultaneous G7 emergency meeting, IEA stockpile release discussion, and Trump's Hormuz seizure consideration are all the specific policy interventions that could prevent the Kpler scenario from materializing. But policy interventions that flood the physical oil market with strategic reserve releases do not change the fundamental reality. The strait is still physically closed to insurance-covered commercial shipping. The reserves buy time. They do not reopen the strait. Watch tomorrow's CPI at 8:30 a.m. Eastern. A moderate print, below 3%, gives the Fed the cover to eventually cut despite energy pressure, takes real yields lower, weakens the dollar, and opens the technical path from silver's current $90 test toward $94.80, the structural confirmation level that this channel has tracked all week. A hot print, above 3.2%, confirms stagflation, destroys the last argument for near-term rate cuts, but simultaneously destroys confidence in the dollar as a safe haven store of value, which historically sends physical precious metals higher through the monetary hedge channel, even as industrial demand concerns suppress the paper price. Both CPI outcomes are bullish for silver's structural thesis. The difference is the timing and the velocity of the move that follows. Oil broke $100, 92,000 jobs vanished. Silver sits at $90. CPI prints tomorrow morning. The map is in your hands, the clock is running. This is financial warfare education. Not advice, not signals. Verify before you act. Invest with logic, not hype. OG, John A.G., out.